Well, Howard, I think we'll get letting people in here. Still a few people in, but we'll let them filter in, but I'll get started. Welcome to the 2022 Halderman Maximize Your Farmland series. I'm Noel, Director of Business Development. And today, Howard is going to 30-minute farmland update, followed by some members of the Wellington group we're very excited to have that are going to talk about 1031 exchanges versus 453 installment sales. And just a few housekeeping things. I will be monitoring the chat. So if you have any questions that come up while we're talking here today, submit those questions directly to me. And then when there's an opportunity to answer those questions, we'll get those to the right person. And if you've registered with us online or you have us, we will record all this and we'll have copies of the slides available. So after we're done today, if you want to review, happy to send those out to everybody at the end, and we'll go ahead and get started. Howard, I'm going to go ahead and mute. We'll let you unmute.
Perfect, Nolan, thank you. And welcome everyone this afternoon. A beautiful September day here in the middle part of Indiana, and looking forward to a really successful harvest that's upcoming. Again, I'm going to spend just a few minutes talking about the land market, both in terms of land values and rents that we're starting to see some indications of for next year. And I don't want to waste any time on that, but we are super excited to have the Wellington group with us this afternoon. Tom, Tony, and Max, I'm going kind of on my screen from right to left, are going to cover an innovative technique with regard to selling highly appreciated real estate that I think you'll enjoy at the back end of the hour. So I'm going to start sharing my screen, and no one just confirmed for me that folks can see the presentation. And some of this I know that we've seen before. So Land Value and Rent Seminar, September 7th. And a lot of this information I have really updated just in the last couple of days because of the timing of this event prior to Halderman staff meetings next week. It is very beneficial. I think most of you know who Halderman is, been around 92 years, based here in Wabash, Indiana. We represent landowners of all types, but primarily just farmland owners across the Midwest. And then you know these statistics as well as anybody. So I'm going to quickly start talking about farmland values. Certainly they are strong today. We are at the all-time high in farmland prices. Even inflation adjusted, we're at the all-time high. And just as a little refresher, we've talked about this in other seminars before, but outside drivers of farmland sales, there weren't many through 2020. Last fall, we saw just a little hint at an outside driver with a fear of capital gains taxes increasing. But kind of that reality hasn't come to fruition. Wasn't a huge driver of outside farmland sales, just a little bit of one. So we haven't had what I would call a big supply. Certainly from 2013 through 2020, we did not. The number of sales did improve last fall and winter. This would have been kind of that October through December, and then also January through March timeframe. And here in 2022, they have remained more of a typical percentage of sales. Now, I do read the farm papers every week. I look through the ads. I would tell you for early September, there are not a ton of sales out there. Halderman has been very fortunate that we've had a number of sales and have a number upcoming, but just the overall marketplace still doesn't look like there's an abundance of properties to buy. Cropland values were stable that 2013 through 2020 time period, really 2015 through 2020, but then jumped up 30%. Now 30% is coming from the Purdue survey. I will show you some statistics that might suggest upwards of 40%. In fact, I read an article this morning that said maybe best farmland went up 50%. Regardless, huge increases in the last 12 months in cropland values. And as I said, we're at the all-time high, even when you adjust for inflation. So a great spot to be if you are a landowner, if you're somebody who's looking to finance your property, you probably are in really great collateral shape. If you're trying to buy land, it makes it more difficult. Interestingly enough, recreational land, timber, and rural residential values higher along with cropland. And a lot of that's driven by low interest rates, high employment, low unemployment. Probably should say it that way just to be clear. So a lot of good things going on in the farm and rural land space today. Here's the Chicago Federal Reserve statistics through July. And you can see that the I states performed very well. And this was year over year, July to July, showing any increase. And I think Indiana's right there at 25%, Illinois a little less than 20, Iowa over 25%, the overall district at around 22. I think that lags what really happened. But again, this is a survey of agricultural bankers that are feeding into this data. So they're probably going to be a little more conservative in an opinion survey. Here is the USDA cropland values. Now, I want to be clear, this is all of the United States. Obviously, if you were to offer a farm at $4,400 an acre in Indiana today, and it's mostly cropland, it would sell in a heartbeat because that would be very cheap for Indiana farmland. But when you go across the whole United States, 4,400, and this just shows you that when you look at the history of farmland values, we've been in a very sideways channel. And now we're seeing this uptick here toward the end of the curve. Now, let's get more specific. We go from USDA numbers to Indiana farmland values. And this is the survey that was published a couple of weeks ago by Purdue. Survey they did back in June. And you can see the hockey stick move up in farmland values over the last 2 years. So really 21 to 22 was the big increase. And this was a 30% increase. These are cropland values. So the best land in the state of Indiana today is valued somewhere on average $12,750 an acre. Significant increase over $9,750 from the previous year. That is real, ladies and gentlemen. We see farms selling $15,000, $16,000 an acre. Some, I don't know that we've had a lot over 20. We've had a few with development influences over $20,000 an acre. But certainly there are a lot of values in the teens today. And that's just shocking to many of you that are landowners out there, because as you could look at the historical perspective, we're in uncharted territory. The interesting thing about the Purdue survey, I do want to mention this, recreational land was estimated to be as high as $9,000 an acre. I did an interview with Farm World on farmland values in this report specifically. And they asked if I was surprised, and I was not surprised by the farmland values. We were seeing this in our sales results. I was surprised by the value of recreational land. I was really surprised that it was up to $9,000 an acre, because on an income basis, it probably doesn't justify that. But certainly, a lot of people have excess cash, liquidity, and they're looking to have a piece of rural real estate. Now, Halderman sales, and we've talked about the WAPI charts before, weighted average productivity index. And just as a reminder, we take the sale price of cropland, divide it by the soil productivity index, the average productivity index for that specific farm, and we come up with $70 per corn bushel of productivity index. And you can see going back into early 21, the market was trading around $55 per corn bushel of productivity index. And that was pretty consistent through the first half of last year. And then you see the big jump. And that really occurred at the beginning of the third quarter in August of 21 and continued consistently throughout the end of the year. And we traded around $80. So 55 to 80 might suggest an even stronger increase than just 30%. So the question is, okay, where have we gone in 22? We'll get to that in a second. Here are just some numbers that show the increase in more numerical terms rather than a chart. And you can see the average in 2020 was $51. The average in 2021 was $71. That's a 39% increase. And really that increase all occurred in the back half of last year. So let's move on and talk about, and we do have this slide in here. I think we talked about this at a previous seminar, the percent of sales over $10,000 an acre. So when I make the comment, it wasn't a surprise the Purdue survey was over 12,000. It's not, because so many of our sales have been over $10,000 an acre over the past year. Here's the trend in 2022. So you go back to January through our sales last week. So this includes all sales right through last week of cropland, and we're trading in the low 80, mid $85 per corn bushel of productivity index. Continues to be a lot of variability from farm to farm. We had a couple go over $100 an acre. That was a pretty average farm in Whitley County, Indiana, a couple weeks ago, and that though you see those that blip up here most recently. But every farm varies. Every farm is unique in terms of its market and soil types, drainage, reputation. So we can't use this as a carte blanche value, but the market certainly is still maintaining that $80 to $85 range that we've experienced. So no downtick in the market, but what you will notice is not the significant jump that we saw a year ago. And that's probably a little more of a healthy sign, in my opinion, that we're seeing more of a slow increase in farmland values as we go forward. Here's the trend, and this shows this big jump pretty dramatically, really. You go back to the second quarter to third quarter of last year, you see that jump up where we had been in the 50 range and then boom, up to 80. Here are just the most recent sales. You saw this on the chart, but we are doing a number of cropland sales over the last month or so, 5 that really qualify. We had a number of other sales that were not cropland, but these really show that anywhere from $78 in Clinton County to $104 in Whitley and Huntington County. Pretty strong market continues right up to the minute as we speak. If you want to stay up to date, up to the minute with what's happening, follow us on our company's app. You can get all the sale results as they occur on each night, or an auction closes online, you can get that data. Now, switching from actual sales data to an opinion again. And I asked our staff in preparation for the meetings next week, what was the percent change in farmland values in your area from last September to this September? And you can see the range of increase. Best cropland anywhere from up 10 to up 30. Average cropland maybe a slightly weaker, but woodlands, that's that recreational aspect, up pretty substantially, maybe up 50%. So when you saw that produce survey at $9,000 an acre, maybe that number's not all wrong. And continued strength for the most part in rural building sites, rural residences. A little hint of weakness, of course, those are going to be more interest rate sensitive and maybe down a little bit here most recently. Who are the buyers? You can see in 2022, a 55% in farmer buyer still remains the dominant buyer for us. These are actual sales results, not opinions. And number of sales compared to previous years. So this is an opinion. I asked the group, what do you think the number of sales are compared to the prior years? And only 17% said more, a third of them said less, and 50% the same. So as I said, not a real robust sales market in terms of availability right now. Dominant purchasers still heavily weighted to the farmer. Now this is an opinion. The previous chart was actual sales results. This is taking in that whole marketplace and who's the dominant buyer. 71% farmer, which this is very common. The farmer tends to be the majority buyer, and that continues in the marketplace today. Purdue Ag Barometer, we've talked about this in other presentations, and it's been interesting that farmland values and the Ag Barometer have not tracked over the last 12 months. In fact, the Ag Barometer continued to go down, down, down until the last 2 months. You can see the results came out just 2 days ago for August, jumping up a little bit up into the 111 mark. The range is 0 to 200, so that's still better than average, but certainly not as high and euphoric as the feeling was if you go back over a year ago. So why would that be? Commodity prices are good, farmland values are up. Well, I think what you see reflected here is really the concern farmers have for input costs, fertilizer, pesticides, fuel, equipment. All of those things are going up in cost. And at the same time, we're looking at decent commodity prices for 2023, but there's certainly no guarantee where those go long term. So I think you see a hint of concern with higher costs, higher interest rates, and really the unknown of what commodity prices will exactly be next year. And obviously we don't know production, but I think that this recent upturn is really reflective of the feeling that we're going to have some pretty good yields this year here in the Eastern Corn Belt. Inflation, we've talked about this before. farmland is almost perfectly correlated to inflation. So we've been in elevated inflationary times, and you see farmland values moving up, probably more along that green line, really, in terms of inflation than maybe the blue line at the top. And then here are the nominal farmland values, and then adjusted by the price index or the inflation rate. And this is where we are at the all-time high. There on the far right-hand side, nominal farmland values, the black line. Adjusted for inflation, we are at the all-time high, as I said earlier. So let's talk about debt. These are some updated numbers. You've seen some of these charts before. Here's the overall farm sector debt adjusted for inflation. So I want to be real clear. If you took total debt, nominal debt, it would be substantially higher than this. But we're really right back at the 1980 high when you adjust for inflation. Asset values, on the other hand, are up substantially from those 1980 highs, even with inflation adjustment. Here's interest rates. Interest rates are rising, and this is a report that just came out a couple of weeks ago from the different Federal Reserve District banks. And you can see on all fronts, they're increasing. Chicago probably the most increase, but it was coming from the lowest level. So some increase, but gosh, historically speaking, still pretty historically low interest rates. Total debt versus interest, and you can see now this isn't so updated, but I think this is a big reason why our farmland value has continued to do as well as it has. You know, debt has gone up back to the 1980 high, but interest cost has not. That obviously is going to tick higher as we go forward with higher interest rates. Here are the solvency ratios up through 2022, and with the higher asset values, farmland values jumping up as significantly as they did. And even though debt's up a little bit, but fairly flat, you get the better solvency ratios and historically fairly low compared all the way back to 1970. So the farm sector is in pretty good shape from a debt perspective. And this is then debt divided by income. It's 4.1 currently, well below the 5.5 that becomes kind of a concerning level. And so we're in good shape, I think. Loan repayments rates, anything above the 100 means we're paying off loans faster than normal. And obviously over the last couple of years, that's been the case. And as a result, lower farm loan delinquencies. So really from a debt perspective, I feel good about where the farm sector is. Yes, prices are up for farmland. Debt is being used. Many of the transactions that we see a lot of mortgage lending being put in place on those. But from an overall asset value and debt versus asset value, we're in a good spot. So where do values go from here? It really depends on farm incomes, interest rates, and supply, as it always does. And I talk a little bit about incomes. The golden era back to 07 to 13 generated a lot of cash. We had this cash drain. Government support was absolutely critical, 18 through 20. Interest rates are now increasing, but the farms for sale have remained below normal. So when you think about farm incomes, I'm going to show you a chart here that says farm incomes are going to be pretty good in 2022. Interest rates are up. Supply remains fairly thin. So farm incomes and supply are bullish. Interest rates are bearish at this point in time. Here's this farm income. And you can see we're almost back to where we were in 2012. These are numbers that just came out in the last week from USDA, adjusted upward. Net farm income, the blue line or the green line, is about where we were back at that high in the golden era. So really, and this is not any government program payments included in this at this point, because they're not going to be much in the way of any paid out unless it was an emergency situation because of some weather event. Cash rent expectations. Now, this is a survey that comes from the Purdue CME Group Ag Barometer. And they asked the question to corn and soybean producers, and it was only to those who expect rents to rise into 2023. And you can see the variation that folks expect to see. And up over 10%, 34 votes for that. 5 to 10%, 39, that was kind of the majority. But there are some expectations that rents will be higher for 2023. These would be fixed cash rents. Halderman uses a lot of flex leasing, so this is going to vary a little bit for us. Impact of trade, when we look at 2020 versus 2021, the big increase in trade numbers from 28 million up to 36 million dollars. A lot of that was done through corn purchases, but all hosts of types of agricultural products went into making that overall increase. That's certainly been a big driver of some of the commodity price changes that we've seen positively. Impact of fertilizer prices. I mentioned these being problematic for producers. This was a year ago. I think corn fertilizer prices have been coming down for the last month, maybe month and a half, but they're still at very elevated levels, probably similar to what these were last fall. And then just as a percent of budgeted revenue, of course, revenues are super high right now, so the percentage isn't as high, but that's the concern, is that we get into decline in commodity prices, and then that fertilizer expense as a percentage could go up above 20%. Impact of timber values, and this is the other part of that income. You think about recreational land being $9,000 an acre. Well, here's part of it. Timber values are certainly going up, and when you think about all the home construction that's going on, combined with cabinets and furniture, so it's not only softwood but also hardwood. Those values are on the increase. Cap rates, though, and this gets into that interest rate discussion a little bit. What's the cap rate? What are you going to earn off your farmland investment? And you can see we're down below 2.5% on a cash-on-cash return today. Doesn't have anything to do with values. This is just your return on investment. So if you bought the farm and rented it out, this is kind of the return you're going to achieve, which has been pretty good compared to CD rates in the past. But where do CD fixed income rates go into the future? And with higher interest rates, they certainly could go above 2.5%. And then does farmland end up as competitive as it has been for against other investments going forward? So we'll talk about our cash rent survey. So I asked our staff, as of September 1st, so a week ago, what were the results of 23 cash rents, if any? And you can see that we haven't done a lot yet because it's kind of early in that negotiating season, but steady to higher is certainly the theme here. You can kind of read the notes there. Not going up a substantial amount, but some increases. Will you increase cash rents? And 11 out of the folks, or 18 that responded, said yes, they would. Anywhere $5 to $50 per acre. Now, keep in mind that $50 an acre is probably on the high side. That's probably a lease that might have been a 2 or 3 year lease, and it's just now renewing, and they're adjusting it upwards for a period of multiple years. So don't take that as a carte blanche statement. I'm going to increase my rent $50 an acre. I'm not sure that's what Halderman wants to communicate here. I just want to communicate that we are looking at some increases for 23 on top of some increases in 2022. Demand for farmland, is there more or the same amount of farmland for rent? So this is availability, the first question. It's largely the same, which is a pretty low number historically. Is there more demand? Slightly more, although 11 people said the same amount of demand, and honestly, demand year to year remains really high for land and rent. That's just the way the farmland market is. If you have any tenants in distress, you can see one of our people does. So you think about it, I think the numbers would be somewhere around 2-3% are still having some financial challenges. So not everyone's in a great spot, and that's just something to keep in mind. Cash flex leases. I mentioned earlier, Halderman uses a lot of flex leasing. You can see that our staff will continue to use more of those going into 2023, although many of them already use a great degree of flex leases. These are really a great tool, especially in a year like this year, when you're taking actual yield on the farm times an average cash price in the area, and the cash price is looking pretty good, and the yields might be pretty good. I think we'll have some bonus payments paid out to our clients on flex leases again this year. So something to discuss with your Halderman rep, but certainly a good tool, we think, to treat both parties fairly. Base gross revenues in a flex lease. These are as high as they've ever been. In my years of doing the survey, had never been over $1,000 an acre as a base gross revenue number, and corn is there. That's reflective of higher input prices. And basically that's the revenue in a flex lease calculation that the farmer is guaranteed to keep first before any sharing of the revenue over that number. So in other words, at 1,050 on that farm, the base rent is due, and that's guaranteed to the landowner, but any bonus would only be paid if the overall revenue is above 1050 per acre. Well, $6 corn times 200 bushel is $1,200 an acre. So there is the potential for maybe some of that to be paid. Soybeans obviously would be a lower number, lower cost to produce, and therefore a lower range. And you can see that maybe some adjustments will come, my apologies, on the soybean side or on the base rent side, but slight adjustments. And we're still, the base cash rent, the guaranteed component is still only 90% of fixed rents. So that remains pretty palatable to most farmers as a tool to use. Here are the cash rent survey for Purdue. Now, this was my other surprise in this survey. Recall the hockey stick jump in land values. You don't see that happening in rents. Rents have gone up, but they've gone up much more moderately. Now, that's not encouraging if you're a farmer and trying to rent more land necessarily, but they didn't go up as quickly as land rents or as land values. So I think that that's where some of this increase in 22 or 23 is really thought to happen, because we didn't increase as much in 2022. So getting into our forecast as we wrap up, long-term world demand fundamentals remain bullish for ag, and you really see this continue to play out. Any hiccup in production in South America, like we saw last year, or any kind of weather issues that we're seeing here in the United States this year, have an impact, an immediate impact on commodity prices and therefore land values. So it's kind of a just-in-time situation. Interest rates are up 1.17% from the lowest ever, which was just 9 months ago, folks. So you're talking about 5.1% on real estate mortgages for 15-year fixed money. It's up. Historically, though, still favorable, in my opinion. And supply of farms for sale did pick up in the fall. They remain more near normal, although as I looked at the farm papers the last week or so, not an overabundance. Government support in 22 is likely zero. And inflation. I put that in all caps because that's going to be the bearish factor in all of this, is input costs rising. And then, no, I can't even read what that bottom line says. No, the next one. More cash, yeah. So thank you, Nolan. A lot of cash came out with the PPP payments, the COVID payments, on top of the increased incomes. And so that is seeing factored into some of these purchases of farmland. Cropland values remain in an uptrend. We still see stronger timber markets, recreational land, rural residential. I put steady to stronger. Our group might be a little more bearish on the rural residential because of higher interest rates, but just something to think about. Average to below average farmland, hassle farms, still less desirable. You just see weaker or slower bidding in those spaces. So on the bullish side, we have profitable prices. Yes, that's where they are today, and we're coming into harvest in the next 30 days for sure. Low amount of debt to assets. Interest rates are up 2 to maybe 4%. You'd say, Howard, you just showed me a 1.17% increase. True, but actually in the marketplace, depending on the lender, it could be anywhere from 2 to 4% higher than what it was a year ago, depending on how they're funded. Farm credit is different than FDIC insured banks. So that's why I show that range. You got a moderate supply of farms for sale. Biofuels, okay, President Biden just came out in the last week saying he wants to set the biofuels RFS, renewable fuel standard, for the next 3 years. Well, what will that be? So still an unknown there. That's why a question mark. But certainly that demand has been there. Renewable diesel, continue to watch that. Those plants, I saw one announced in the last few days in western Nebraska. So that could really demand a lot of soybeans across the Midwest if that continues to grow in popularity. And these other factors. The bearish side, really what if, pandemic. The impact from the pandemic, I don't know, is a huge deal across most of the world except in China. And China's a big buyer of our commodities. And as they shut down entire cities due to COVID, there's still some impact out there. Probably the bigger impacts today are weather and trade. and trade gets into the Ukraine-Russia conflict and how that impacts prices. And so I think you got to kind of watch all of that combined with global production. The prediction for production of soybeans in Brazil is all-time record high production, both for corn and soybeans, honestly. Soybeans up to 150 million metric tons. Now, the planting of those beans occurs over the next couple of months down there, but that would be an all-time record. So you're seeing really prices, higher prices stimulate production, and will that equal lower commodity prices going forward? Any kind of worldwide economic tanking, what's happening in Europe right now with high natural gas prices, there's certainly some concern out there about recession and what will that do to demand. Biofuels RFS mandate, I had it a positive, I also have it as a potential factor, because who knows. And then interest rates increasing. I did put in here that really some of the impact might not be felt until the second half of next year, because that's really when interest rates start to come home on operating lines for next year, as well as for farmland purchases here most recently. Maybe not all having a big impact just yet. And then we talked about other asset classes, returns going up and creating competition, stock market, liquid treasury, CDs. Working capital concerns, I think, are largely over for now. We're in a really bullish time period. Higher prices, higher demand for rental land, and that equates to higher land values. So the market is pretty much steady to up. Here were the expectations our staff has from really, and I didn't change this slide. I'm still very disappointed. Sorry, folks. This is September 1st of 22 through March of next year. So this is our prediction going forward. You see that our group was kind of in the same. You know, we're not going to see land values change a lot. So if you remember the WAPI chart, we've kind of been sideways in that $80 to $85 range. That probably continues as we go forward as kind of our prediction. So not a decline on farmland, but certainly not the rapid increases we saw a year ago. Rural residential lots and recreational land, that might be more interest rate impacted, especially if we get into a recession. You could certainly see some demand in those two classes go down. And so therefore, our group was largely sane to bearish in those two land classifications. So with that, I'm going to wrap up. Nolan, what questions do we have? All right. Well, I think we'll turn it over to Tony Bonanno and Max and your team there. Tony, I'll let you take it away from the Wellington group to talk about 1031s and 453s.
Awesome. Howard, can you hear us?
I believe so. And then Nolan, can you let me, Max Moritz, allow my screen to be shared? Thank you. There we go.
We have audio. Nolan, we good?
Yep.
Can they hear us? I don't think they can hear us.
I think Nolan shook his head.
Yeah, we're good.
Yep, you're looking good. Your audio's looking good. I can see your presentation, so it should be good to go.
Awesome. Howard, thank you for your time and thank you for a long-term business relationship and to everyone on the line today. So today we're going to go through what we believe is a complement to 1031 exchange, which is a 453 transaction, which a lot of people aren't familiar with. It's becoming more popular today, especially around Indiana, because of the Eli Lilly expansion up in Boone County, with Lilly buying a lot of lands. We've seen anywhere from $60,000 to $65,000 an acre in Boone County. We did a seminar with Halderman. We had many farmers in that area are becoming instant millionaires, multimillionaires, because of the land acquisition by Lilly. Then the IEDC is allocated anywhere, we hear about $165 million to buy more land up the I-65 corridor up to all the way up from Boone County to Lafayette. So we have identified about $300 million of farm ag land in that area that's going to be transitioned over to the next year. So this is why we are giving our clients alternatives to the 1031, and it's a complement again to the 1031. We think the farmers are having a hard time because of low supply of land, as Howard mentioned, and all-time high of ag land. The 453 gives them an opportunity to take their cash at closing on the 453 transaction, which we're talking about, getting about 93.5% up front, and allow then the Halderman Farm Management representatives then take their time to seek new land opportunities in the future for our clients or the farm ag clients with potentially lower prices or at the right area and price and time. So Max is going to go through, we'll all go through the differences, the pros and cons of 1031s and 453s. Please ask questions along the way on the chat line, and hopefully we can answer them all. So appreciate it. Thank you.
Tony, thank you. Howard, I appreciate the time, as this is a definitely a condensed presentation that we'll kind of walk through, as Tony gave an executive summary of all, I think, 7 slides that we have to go through. But whenever we work with clients, is we really work through a decision matrix that everybody has, whenever they're selling lands, right? The first decision that someone has to make is, do they pay the tax or do they defer the tax, right? And so roughly when someone's selling land, is they walk away with anywhere between 69 to 72% of their sales price or their net sales price, which I'll show how I got to that number in a few slides in the actual monetary example. But in deferring the taxes, you really have 4, I would say, main options when it comes to tax deferral. As you can use a charitable remainder trust, you can use an opportunity zone, and what the most common one is that we see is 1031 exchanges. And so what I want to spend quite a bit of time on today is what the most common, and then a complement to that common. So a 1031 exchange versus what we call 453 monetized installment sale. When we look at 1031s, is I like to keep it very, very simple when presenting to clients in kind of complex concepts. So it's simply a pros and cons list, right? And a lot of these are what you're familiar with. So, and a pros of a 1031 exchange is we can defer tax for really an undetermined amount of time, right? So you can keep rolling land into new properties as you want to sell, or you're forced to sell, and you identify new property to keep growing and keep deferring that tax. Right, so I always say undetermined because you get a set whenever you want to pay that tax bill, right? You continue to own land or property. You can also own commercial property, whether it be triple net leases for Dunkin' Donuts, for Papa John's, for Walgreens, CVS, whatever that is. And with that is that income potential from that exchange, right? So if you don't want to continue farming yourself, is whether you cash rent it, like Howard talked about, or you're going into commercial properties that are paying triple net lease payments to you on an annual basis. And I think the biggest pro here is you have 100% of your sales proceeds working for you, right? So when we talk about how do I defer tax, if you have identified property that works for you and what you want to do, is you should absolutely be doing a 1031 anytime that you have property identified for you, right? When you don't have that property identified, is there's some cons there, right? Time constraints can sometimes be almost the death of a deal, right? Meaning someone can't really decide, or they're forced to decide on a piece of land that
just to defer the tax.
Just to defer the tax, right? Sometimes they let the tax tail wag the dog, which they're just buying land to buy lands, right? Bullet point 3 right there is they just buy land to defer the tax. Whether there's good land available or good property available, they're just doing it because they don't feel they have another option other than paying that tax bill. Sometimes what we find is, they can't find property for the same value of what they're selling. And so that creates that boot of a taxable boot there, that their original basis is transferring first, and they still have a little bit of a tax bill due. And what we've heard from some individuals is they're really in the same spot they are today. Right? Whether it's their family from generation to generation, or from them acquiring land and growing their land's holdings over their lifetime, is they're back with all land and no cash proceeds. And so I think that's where that decision is, how do you want your assets to look, whether it's cash or land or commercial property, is how do you want to structure an exchange or a tax deferral? And so when we looked at options in the tax code of tax deferral, is one that we found that works great for farmland and ag-related land only, right? It's a 453 monetized installment sale. And so we'll go through the pros and cons and explain how it works a little bit, right? The first is, you're getting 93.5% of your net sales proceeds working for you, right? And you get that 93.5% about 5 days after close, wired to your bank or investment account of your choosing. Where that's important is there's flexibility for you, the seller or client seller, to decide when and how to invest your money, right? Is you don't have a time constraint of a 45-day and 180-day period as you do with the 1031, right? However, we talk about maybe good cash rent land is really not available right now, or is the 2% ROI what you're looking for? If the answer is no, is what if we took that money and waited and identified property that fits what you want in the geographic location that you want outside of the time constraints? The other benefit, right, is we defer our tax bill for 30 years. And I think the most important piece is sometimes the tax code just works for you. And what I mean by that is there is explicit special ag exemptions in the tax code to utilize 453 monetized installment sales.
And Max, let me interject here. It's very important that we are only doing and recommending a 453 installment sale for ag only. We would never do a 453 for a non-ag sale of the business. So you were going to, that's important because the IRS does not like a 453 installment sale outside of ag. You have great lobbyists, the ag exemptions in the code, and we're using it to our advantage today.
Exactly. And so Tony hit on that cons piece, right? It's too good to be true. So that 453 monetized installment sale as a general tax rule falls within we call it the dirty dozen list in the IRS, where they're not big fans of them. But when you read their ruling on 453 monetized installment sales, you get to the very bottom of the memo, it says there's an exemption for agricultural land. Why is that? Is there's in what we call it, it doesn't violate the pledge collateral rule, right? Which means it's not constructive receipt of the dollars, which means it's not considered a taxable event when utilizing a monetized installment sale, right? When we talk about why haven't I heard of it, is a lot of times current advisors are just unfamiliar with the ag exemption of the concept, right? They see it for, I say pre-2016, as they see it a lot for commercial properties or businesses. And then when it was maybe, I wouldn't say frowned upon, but the IRS, but on the dirty dozen list, the IRS says, hey, we're going to be maybe looking at it a little bit more closely for non-ag purchases. As CPA said, I don't want to read through all the exemptions in there, and maybe that's why they're not overly familiar with it. And so what's important is we start all of these transactions as a 1031 process, right? Is we want you to have 100% of your proceeds working for you if that's available. If there's a property that you have identified that works within the construct of what you're looking for from an ROI, from price, from geographic location to crop that you want to be there, or whether it's a triple net lease situation, is we always start as a 1031. And then if we get through the due diligence and you say, you know what, I would really just like my cash or as much as I can up front, is we can kind of bail out of a 1031 into a 453 monetized installment sale. So the way the next two slides are designed is the green boxes on the left-hand side are what you as the seller or you as the agent of a seller you see or involved in. And so I kind of put, if you want to see how the watch is made, is we're going to show all the steps here, but really what you're involved in as the seller is what's on the left-hand side in the green. So when we start is, the first is we find and identify a qualified intermediary that you sell your land to, and in return, that intermediary is giving you a promissory note that they're going to pay you interest only for 30 years with a balloon payment at the end of that 30 years. So we talk about that 30-year tax deferral as that's how it's structured in that installment sale type of note. At the same time, that intermediary, just like they're doing in a 1031, is they're turning around to the end buyer and selling that land for cash, right? So there's not a lot different there from you as a seller, or really the end buyer is they get the land and they pay the cash, right? Nothing changes for them.
And we provide the intermediary to them.
Exactly. At the same time is now that you as a seller have that promissory note, is we go out to the lending and capital space and say, Mr. or Mrs. Lender, I have a promissory note here that has an interest-only payment for 30 years with a lump sum payment at the end of year 30. would you loan me money against this promissory note? And the lender says, yep, that is a valid promissory note that is secure, is I'm not breaking the pledge collateral rule, is they will lend, I call it 95%, but after normal lending fees, it ends up netting 93.5% of those net sale proceeds. I say at close, it's about 5 to 7 days after close, is wired to the bank account or investment account of your choosing. Right, so now that you, as the seller, have that 93.5% in your pocket, as you're really out of the transaction for the next 30 years. Right, behind the scenes and under that watch face is that intermediary. Remember, they're paying you interest for every year for 30 years. Well, it just so happens that your note is interest only for 30 years with a balloon payment at the end of 30 years. We set up an escrow agent so that everything is automated for the end seller, right? So the interest that's due to you from the intermediary is paid to the escrow agent, and the interest that you pay to the lender is paid from the escrow agent. As long as you are a party to that escrow agreement, you have a non-recourse loan for 30 years. I think it's important. A non-recourse loan for 30 years, meaning if the intermediary for any reason doesn't pay you interest, you are not liable for the interest due from you to the lender.
And it's not an event of default either.
Exactly. The intermediary at the end of 30 years makes a balloon payment to the escrow agent. The escrow agent then pays off that loan at the end of 30 years. And then you finally get your tax bill from the capital gains that you deferred for 30 years. You get the 1099 from the IRS that you then pay your tax bill. Right, so again, that's a lot of moving pieces, and we really break it down to 6 steps, right? Again, green as you, the seller or agent of the seller, is you see those green boxes. And a quick question I'll answer here is, does this work for individuals and LLCs? As long as it is an S Corp, it's very easy to do. We can do it inside of C Corps, but remember, you can always defer one layer of taxes. You can't defer both layers of taxes. But individuals and S Corps or LLCs taxes S Corps are very, very easy to do. You can do multi-member LLCs. You can do it at the entity level, which is the easiest, or you can do it at the individual member level. Completely up to you. I think the highest LLC member agreement we've done is 4, and from a multi is very small as 2. So from the design, it's, I think, top level or high level, it seems much more, I'd say, complicated, but following the steps makes it a very, very simple transaction that's not too much different than your 1031 transaction that you may or may not be familiar with.
And again, we provide the lender and intermediary for you.
And escrow agent.
And escrow agent. They know each other. They are in tune with the transaction. You do not have to seek out the intermediary or the lender. It's all provided.
Traditional lenders would never do this.
Correct.
Correct. And so the question is, you know, if I could go to a state bank and have this designed, the answer is maybe. Is they fall under a little different of lending requirements. So we go out to capital partners in the non-traditional lending space to provide that flexibility to loan against a promissory note as their quote-unquote form of collateral.
So we'll repeat again, non-recourse loan, and you're not responsible if the intermediary doesn't pay interest.
Perfect. So we talk about the safety factors because everyone says, this sounds really great, but how am I protected as the seller? Right, is one, there's those special provisions in the tax code for farm and farm-related assets. The lender does not require collateral or personal guarantees from the seller, right? The only collateral of that agreement is the promissory note. That loan, with it being a non-traditional lending source, is that loan is not reported to any credit reporting agency. And again, that lender is assuming all financial risk because of that escrow agreement between you, the intermediary, and the lender. And to keep it simple is we make sure that between the intermediary, escrow agent, and the lender, it's all automated under the face of, and using that analogy, the watch, right? Under the watch face is all done behind the scenes for you so that you're not having to remember to take the interest and pay the interest over time. Good question. That 93.5% is you can do whatever you want with those funds. In the example in Howard, what we've talked about is, sometimes people have a hard time paying $17,000, $18,000, $19,000, $20,000 an acre. They want to own land, but they just have a hard time paying that right now. So by taking that money and now having it in their bank account, is they can wait and identify property that fits the acreage per acre range that they're willing to pay, and whether they want to farm it or if they want to cash rent it, to find an ROI that fits what they're looking for. So that 93.5 allows you could spend all of that money if you really chose to, is then your estate or you in 30 years would have to figure out how to pay the tax bill. But we always work to make sure we set aside dollars to make sure funds are there to pay that tax bill in the future. That's a very good question though. So when we look at these side by side, right, cash liquidity upon sale is, right, 453 is yes, because you get that 93.5% at 5 to 7 days after closing. I think it's also important to note that any existing debt can be refinanced as part of that transaction, right? And so how we talked about the farm debt is raising or rising on an inflation adjusted piece, is I've worked out of bankruptcy sales before, right? Of trying to walk away with some sort of cash in hand instead of just paying off the debt and then having to pay a big tax bill the next year, right? So we can look at distressed properties and from workout divisions, or if you have a large loan on there that you can't pass up a deal, but you have a big tax burden, it's a very good way to say, hey, I want at least to walk away with some sort of value. I talked about the 45 and the 180 day periods, right? Is 453s is you have that, you can take that money whenever you want. And to that question we just answered is you're free to invest in other assets. You can absolutely say, I have a very large gain and a deal of a lifetime is maybe I don't want to buy all of farmland, right? I can take a portion of it and buy back into land or a real estate trust, or however you want to structure that. You can do a partial 1031 and then 453 the gain. So it's not an all or nothing proposition, is you can mix and match. And I think that's important of why we start down the 1031 process, just to make sure that there's nothing out there that catches your eye, right? Because with that basis transferring first, if say there's a small commercial property or small farm that's available and you still have a very large gain, is we can still defer that tax for, that 30-year period. And so we talk about Main Street versus Wall Street, right? Is Main Street is becoming more, I would say, in vogue because lenders are finally available to Main Street. And I think that's the biggest piece of it. I think the lenders saw there's a large amount of value and volume on the non-Wall Street level. And why it's easy for Wall Street is they can go find their own capital sources, right? And so we look at the 10 largest transactions for the last few years of using that 453 installment sales, all use $4.8 billion from international paper. As we talk about, does the IRS or whoever know about this? And the answer, I would say yes, because that's going to be on their SEC filing reports, on their 10Qs, of they're deferring over $2 billion of taxes from their sale.
They sold timberland.
Yep.
Timberland.
So international paper, you say that's a large corporation. Well, timber is considered ag and ag related, right? So it's not just tillable ground is what they consider in the farm and farm properties, right? You see St. Joe Paper Company, Kimberly-Clark, Office Max International Paper, Plum Creek. That is all going to be timberland that was sold and that gain was deferred. The question that popped up is capital gains tax rate set at the time of sale. It's going to be at whatever that capital gains rate is at the end of your 30-year deferral period. So we've really calculated out is for it to be, you could have a capital gains set at 100% and you're no worse off because you at least have the money in your pocket moving throughout time, right? And so what I mean by that is when we look at just a cash-on-cash transaction and something that we're seeing, I would say fairly familiar in a lot of the transactions that we've been working with, is extremely, extremely low basis in regards to the land value in some of the areas that we're working in. So for this example, so I had a land value of $10 million with a cost basis of 10% of that, so $1 million. Just paid a 3% brokerage fee, basically brokerage, closing costs, etc. And then a tax rate of 28.8. And so at a deal of this size, is you have federal capital gains at 20%, we'll call Indiana taxes at 5%, and there's a net investment income of, and kind of an excise tax of 3.8% to get to that 28.8. So when we put this side by side of the decisions that I have, either to pay the tax or to defer it, on the left-hand side, you see 10 million, less my brokerage commission, less my basis. So I have a taxable income of 8.4 million at 28.8%. Well, my tax bill due is that 2.49. So based on, I can't, it looks like it cut my screen off a little bit, so I may exit out so we can look at it a little bit differently. There we go. Is we have a net cash. If you said, you know what, this seems too complicated, I don't have a 1031 alternative, I don't want to understand a 453, I'm going to walk away with 69.88% of my sales price, right? So that's 6.9 million, almost 7. And that same transaction is, what if I just decided to defer that capital gain from day one for the next 30 years? Right, that same 10 million less my brokerage commission. And since I'm not having a true sales, I don't have a basis there, right? Since I have an installment sale over time. So my net installment sale amount is 9.4 million. 93.5% of that is call it just a hair under 8.8. So my day one at closing improvement is 1.8 million. For a lot of people, as you say, that makes a lot of sense to at least explore this further. And I think of it a little bit differently and say it's really not a $1.8 million decision, because remember, it's now that I have that tax deferral cash in my hand, what if I just set that aside and really didn't do anything or with it for 30 years, right? If I just used a modest 5.5% growth rate at 30 years, that 1.8 actually grows to $9 million. Since we don't know what tax rates are in the future, I'm going to use the same 28.8, which is that 2.4 million, and you walk away with a net gain of $6.6 million. So again, instead of being a $1.8 million decision, it's a $6.6 million decision. The question that popped up is, you know, what happens if the seller doesn't live all 30 years? Is very simple. The estate is going to get a 1099 in 30 years. Very, very easy to do, is you just file an estate opening every couple of years in the county court, just to keep that estate open. Sometimes we draft legal documents that retain assets to pay that future tax bill before distributing it out to all of the heirs. LLCs potentially could work a little bit differently, but it's an untested piece that don't really want to plan around. So we'll talk through the benefits to sellers, right? We talked through more cash at closing than alternatives. I say it's a complement or an alternative to that 1031 exchange. That liquidity to invest, right? So now that you have that money in hand, is you can go wait until land is at a more attractive values for you. You can go buy whatever you want. Commercial property that wasn't in the 1031 portal. You could stocks, bonds, real estate investment trust, whatever you want to do. And again, there's that special provisions in the tax code for farm assets. So there's one more question that popped up, Howard, that I want to make sure that we answer. The question was, you know, we have good rental income from farmland that's continued to increase. Why should we consider an exchange to an unknown asset via 1031? I think where 453s or 1031s really make sense, and where we've seen it, is that economic expansion where a lot of people don't have the choice to sell or to continue that cash rents, right, with extremely highly appreciated assets. If for some reason you're starting to see your cash rents not increase at the same pace that you wanted, or they're not at the ROI that you want over time, and you say, you know what, I'm kind of done dealing with this, is I really want just to take my money and retire and not have to think about it anymore. As that's where whether it be a 1031 or a 453 can make sense, right? Is if someone enjoys the rental real estate and they like owning the land, is they should keep kind of clipping
Exactly,
those
Max.
coupons from the cash rent.
That was going to be my answer, was that if you are happy with your farm asset and you have no intent of selling it, don't. This was purely an issue because of what's happening in Boone County and some other locations, honestly, throughout our footprint, where there's, expansion going on, be it housing developments, commercial expansion. And so some landowners are getting the opportunity to get maybe $65,000 an acre. Or honestly, if you could get $20,000 an acre and your cash basis is $1,000, you still got a big capital gain. So we really wanted to bring these techniques to you, the landowners on the call, to make you aware of another alternative. So that's really the whole gist of it. But if you're happy with your farmland investment, keep it. Don't worry about it. This was just informational. Max, there were a couple other questions that came in the chat.
Yep, the first one was, 30 years, because I'd say do it over 10 years, is you can always prepay the IRS, right? And then you lose complete control of those dollars, right? So we know what that tax bill could be in the future. Is they'll always let you pre-deposit those dollars in there. And from a plan design perspective and kind of that planning technique, is we can set aside dollars to pay that tax bill in 30 years so that you, in your mind, paid it and you don't have to think about it again. But from an installment sale period, is we just have that note set to a 30-year period. But there's always ways that you can design prepay the IRS. The second question is, how far ahead should we plan if we don't want to do a 1031? We kind of want our cash proceeds. We highly appreciate it. Is if it's really, really in a pinch, is we can get it done in as little as 10 days, but prefer anywhere between 30 to 60, ideally 45 to 60, to walk through with all parties, whether it be your representation, CPA, and legal, to make sure that they understand and are on board with the concepts, to make sure that they kind of give their blessing as well. So we can turn it around pretty quickly, but the more time, the better, to make sure everybody has a full understanding of how that works.
We have up until the farmer selling has cash in hand, we can do the 453.
About 10 days,
Yeah,
right?
10 days. You got to give us, you can do it in about 10 days to 2 week period of time. And the other question was location. Wellington Group, we're located here in Indianapolis, down at Keystone the Crossing, in the business district, the 9,000 building. We have an East Chicago office. We have a Fort Wayne office. So we have 3 locations in Indianapolis, and we have other affiliate offices around the country, but main offices are again here at Keystone, East Chicago, and Fort Wayne.
And then kind of list the locations across the country as well.
Other affiliate offices around the country are in Cleveland, New York, New Jersey, Boston, Boca Raton, Florida, Nashville, Tennessee, San Diego, Los Angeles, Indianapolis. So geographically, we cover the whole United States. So if you need access around the country for these concepts, we can really do any farm asset in the United States, in any state.
And similar to Howard, is we work in all 50 states when it comes to tax concepts and investment concepts, as well as kind of estate planning and financial planning. So a question was, clarify who pays that monthly interest. As I kind of went back to the screen here, is that intermediary is, for that promissory note, paying you an annual interest on an annual basis, and then on an annual basis is you're paying the lender equal of that interest. So kind of behind the scenes is that intermediary is paying that escrow agent, really that interest that's due to you, and then that escrow agent is paying the interest that's due from you. So for you as the seller, is you're not touching that interest on an annual basis, all done behind the scenes. So that's kind of taken care for you. Is we try our best and we really get the intermediary and the lender to match their interest rate, so there's no out-of-pocket cost to the seller outside of, call it that 93.5% that you net, right? Is we have the lending cost, and there's no lender that'll lend against 100% of the assets. So that's really what that quote-unquote cost would be.
And Howard, we totally agree that every farmer should do a 1031 exchange if they get the right property identify the right location and the right price. Absolutely, because 100% proceeds go there. We totally believe in that, and that's what the farmer should do. If they can't do that, we believe that 453 makes sense to get 93.5% of their proceeds up front. They can now reestablish basis, gives them time to reflect on with a Halderman Farm representative to choose now at their terms when to go back in the farm market if they want to, at what price, when location. This gives them time to reflect and not, again, just buy a piece of land to defer tax in a big, let the tax there wag the dog kind of scenario.
Well,
So-
bottom line, we don't want the Halderman reps to lose an opportunity to serve their clients because
Of a time constraint.
Yeah.
Time constraints.
I know they probably have, they gotta get, on with their agenda, so.
Any other questions?
That was all that I had come through.
Hey, I really thank you guys for bringing these ideas and concepts today. Again, the Wellington Group office that I work with are those guys right there at Keystone at the Crossing. So if you've got their information, if you need any connectivity to them, they're outstanding. So with that, we're going to wrap up today. Nolan posted in the chat how to get a hold of us. We do have a recording of this today. So if you want to send it to other family members, landowners you partner with, whomever, we're glad to share this broadly. So just let us know. And with that, we'll let you get back to your day. We certainly appreciate your interest today and listening in. And hopefully it is a fantastic harvest season for everyone. Have a great day.
All right, thank you. Thank you, everyone.
Take care.